Are Treasury market sell-offs the new normal? Hi, everyone. I'm Maggie Lake, and today I'm talking markets with Vincent Deluard, Director of Global Macro Strategy at StoneX Group. Hey, Vincent. It's wonderful to see you again.
Pleasure to see you. Happy New Year.
Yes, it is a busy new year, is I think what we've all been kind of you can tell by everyone's face when they come on. It's like, oh, deep breath. It's been a lot that's happened since we sort of resumed trade for 2025. It's been a roller coaster, but mostly up when it comes, certainly when it comes to stocks. There just seems like there's a lot of unbridled enthusiasm around the Trump administration's agenda and what people are hearing. We saw US stocks traded up again. The S&P 500 hit a new record. And interestingly, tech very much leading the way again, the Nasdaq over 1%. What happened to all the talk of an AI bubble and all those concerns people seem to have as we sort of rounded out last year?
Well, what happened is five, billionaire oligarchs, hundreds of, well, how many $1 trillion of net worth was it at the inauguration, showed up at the Trump inauguration, and I think from what I see in the media, they're reading, oh, Trump is embracing big tech, and these guys are just going to split the pie, and I think it's completely wrong. I mean, what I saw yesterday was not at all an embrace, but more a ritual humiliation of having these people bend the knee in front of the Sun King. And my guess is that Trump probably doesn't forget so easily that Jeff Bezos and Mark Zuckerberg and all of the above tried to take the election away from him, at least in his view. So I think he's quite happy to parade them and display them the way maybe an old king would parade slaves taken from a foreign rival. But I doubt that the Trump administration will just embrace the tech bros and the tech. I mean, some tech bros will be embraced, the one that supported Trump from the start. But I think the one who just changed their allegiance at the last minute will pay the price, because that's the way Trump works.
Wow, that's so interesting. And I think that it I was watching that and thinking that it's not an accident because each of them started by saying this couldn't happen without you. Like it seemed almost scripted,
Yeah.
you know, and very public in a way that we really haven't seen before. So it's so interesting to think that there's a so that's like sort of palace intrigue to watch. Do you think that that favoritism and that um public support, however Trump may roll with that, do you think it has a material impact on their businesses?
To some extent, yeah. I mean, you have investigation, FTC investigation into Google, into Meta, a lot of government business. So yeah, I do believe that they are. When you're as big as these companies are, I mean, you have a hand in everything, and you become a political entity, whether you like it or not. I mean, if I were to take a metaphor, um, what I saw yesterday kind of reminded me of what Putin did to the oligarchs about 10 years ago, when he was supposedly Putin was the man of the oligarchs, right? He was put there, and then around 2004, he started going after them. Started with Mikhail Khodorkovsky.
Yeah, it was like a purge.
Right. There was a purge, and it was basically, okay, I'm the boss, bend the knee, we'll do 50-50, and your 50 is negotiable going forward. And
Mm.
I suspect it's going to be the same thing. I mean, we are really, seems to me that we are moving towards this kind of almost thuggish capitalism model of, the clan. And yeah, you have to pay tribute. And I think that's what the tech lords are going to do. But I guess we get, time will tell.
Yeah.
We had an all-time high right now, so maybe Trump is indeed a forgiving man, and he will forgive the people who tried to hurt him so badly, and it's good to pay 26 times earning for the S&P 500.
Well, this is why it's complicated because they may be able to contribute things that are desirable. We'll see. Maybe they're better maneuvers, than we think.
What things could they give him? I mean, other than writing a check for his inauguration and
Yeah.
bending the knee and giving. My impression is that Yeah, there is. I hear that little um, music here that Trump is just kind of a bumbling idiot, and you just have to
Oh, I
flatter
don't
his
think anybody
ego.
should think that now
Yeah, but
after the
that is the narrative, right? That you have
yeah.
all these smart tech oligarchs that, you know, oh, well, they bet against him for 8 years, but now all they have to do is sign a check and tell him that he's the greatest, and go to his inauguration.
Mm,
And then he's so vain that he will just forget. I doubt that, Trump is like that. I mean, he may project that image, but yeah, what exactly can they offer him that he wants? I mean, he can't run again.
yeah.
So I think he's
Yeah, and then
um,
you'd have to you'd have to try to explore, like, sort of legacy, a really strong economy, breakthroughs on certain things, but, but like you said, maybe it could be achieved by favoring someone else. This is, I think, a really important thing to bring up, and by the way, this is, as we always say, this is just if you're gonna try to quantify the risks out there, right? These are all things that you have to consider, especially if you hold any of these stocks in your portfolio. Um, when I was just beginning, I remember I had to cover Microsoft. I mean, it wasn't the beginning, but it was my beginning of me at CNN. I had to cover the Microsoft trial. And I remember someone saying to me one time, in the end, they probably won't be broken up, but it costs a lot of money and time to spend your time in court, or it like sucks away a lot of your, direction and the time you'd spend sort of beating your competitors when you're spending it all in court. So you're right. I mean, it could be very perilous for those who get it wrong. What about so clearly that Stargate initiative, and it was interesting to see who was up there too, right? Not Google, Amazon, it was Oracle's cloud. Larry Ellison has always been aligned with him. But if you X that out of the conversation with stocks, what about earnings? Because we did also
hmm.
see that Netflix is a big mover today. They came out with much better numbers and subscribers than people expect, although it will be the last time they report out that metric. We had banks come out of the gate,
Mhm.
investments bank come out of the gate strong. Are earnings enough to justify the levels we're at, Vincent?
I don't think they're enough to justify the levels we're at, but they're certainly very, very good. Um, my way of tracking the economy, as you know, is looking at tax collections, and we had a gangbusted December. I mean, growth insane. I mean, that actually made a significant impact on the deficit. Seeing 10% plus growth in tax collection. So um, I'm not surprised that we're seeing very strong earnings, especially for financials, obviously, that benefit from, um, you know, JP Morgan, Bank of America. Again, they have their hands in pretty much every every
Mhm.
pot. And then for consumer-oriented stocks like Netflix, I'm not surprised. My only caveat here, and this is just a feeling, it's not born in the data at all, is I, I kind of wonder how persistent this is going to be. I suspect quite a bit of the energy in December was coming on the back of these massive gains in 2023 across stocks, even bonds, crypto obviously through the roof. And then we had the confidence shock of the Trump election, where the 50% of the US population who thought they were living in the Great Depression then suddenly woke up and realized everything was fantastic. And you could saw that in small business confidence. So yeah, to me, I'm not sure that this is something that's going to be replicable going
Mm.
forward. I mean, it could be. I mean, again, I would not underestimate the power of the U.S. consumer, the magnitude of the wealth shock. I mean, you got household net worth. Household assets minus liability increased by 50 trillion since COVID. I mean, this is a number that we can't even fathom. It's half of world GDP. So maybe the engine can keep going. And you had me on the show many times before. I've been telling that story for 3 4 years. Like, stop worrying about recessions. Like, we have this soaring gig economy. The economy.
Yes.
So it could be that it keeps going. My worry is that at some point, things just get so good that it's going to make comparables much harder going forward.
Mm.
When you see, I don't expect that we can sustain 10% growth in tax collection month over month, like, or then all our troubles will be taken care of, right? I mean, don't have to worry about anything. So I suspect it will. I suspect also someone had to have the population boom that we experienced, and that's over. I mean, it will change things. Like, how many immigrants did we get in the past 2 years? 6 7 million. That's going to boost growth, and that's
Mm.
something that's going to go away. So uh, again, I think we'll need to wait to see it in the data, but I wouldn't be surprised if we actually see the economy slow because of the insane speed at which we're growing in Q4.
So it's we're almost stealing from the future, or we've kind of sort of consolidated everything into this boom because you've been pretty consistent in the pro growth. Like I don't know if you want to call it no landing,
Mhm.
but
Yeah,
you
yeah.
you've been really consistent in that. Do you see it just slowing down so it's hard to live up to these lofty expectations, at least for equities, or do you actually see the risk of a recession?
No, for now, let's just stick with the slowdown, and then if there is a recession, we'll take it there. My guess is going to be hard to have a proper recession in the US. I think the more likely outcome is something that feels stagflationary.
Mm.
Um, and again, there's 15 executive orders every day, major policy shifts, so it's hard to make any sort of forecast. But let me do an ex-Trump forecast. Ex-Trump, my impression is that the economy would be slowing down in Q1, Q2, if you let it on its own, partly because it's been running so hot, partly because immigration has slowed already. The peak in immigration was more than 6 months ago. Partly is because of the high interest rates eventually taking their bite. You look at new home starts. Well, California may change the equation, but for the wrong reason, unfortunately. But the construction sector is probably going to turn into negative job. So from creating 20,000 jobs a month to destroying 20,000 jobs a month. State and local government, who were the big recipient of the infrastructure bill, the CHIPS Act, the IRA, are cutting down. So my best guess is right now we're probably growing about 3% real is my guess. So you know even if we slow to 1.5, which is still a decent number, but that would be a halving of real growth. So that's my guess of what the economy would do. Also because the dollar has been so strong.
Mm.
Now again, there is a Trump question. I think it will create a lot of volatility. Some of the things that will announce will feel very pro growth. Others will hurt growth. So we'll have to see. But I think the gravity points towards slowdown. Yes.
So you said something really interesting in one of your notes, and we have a question. Hey, everybody in the chat. It's great to see you. We have a question from Christopher, wants to talk about treasuries, and so do I. And someone else wants to know about the BOJ raising rates. So we're going to get to all of that. But you wrote something in your note which I thought really jumped out at me, and you said events are rarely inflationary, but societies are. I thought that was so interesting. What are you looking for from inflation? And bond yields did edge down a bit, and I think the hope is that inflation kind of stays subdued. And again, I think we got to like take the tariff out of it for the moment because it's really just hard to game out what that impact is. But generally, what are you expecting for inflation, and then what's the knock on for treasuries from that?
Well, generally, I've been in this kind of um, 2% target is dead. We have reset to a world of high inflation around, my guess is around 3.5%, which is not necessarily a bad thing.
Hmm.
And yeah, the idea with events are non-inflationary. Our reaction is initially, I mentioned that in the case of COVID, uh, you could make a case that COVID should have been deflationary. Basically, commodity prices collapsed, consumption collapsed because we were all stuck home. You could also have made a case that it would be nothing. Right? In the 1960s, we had I think it was a Hong Kong flu that killed about as much as COVID, and we didn't even notice because at the time the boomers wanted to explore consciousness and do drugs, and we're not worried about mild symptoms. So my point is, yeah, events, and in China, for example, COVID was a deflationary shock. What made COVID inflationary was that we increased bank reserve by 8 trillion. We blew up the deficit, and 4 years later, we still have a 7% deficit of
Because we sort of
GDP.
changed our behavior.
Exactly, it's the way people respond to events. So initially, I made that comment about COVID, and I was thinking about it in light of the California fires. What are we going to see in California? I know it feels like it was 200 years ago, but that was actually last week.
Right.
And we destroyed 10,000 structured. We have hundreds of thousands of people who've been displaced. We have damages in the hundreds of billions of dollars. And one of the first things, for example, that was announced, and I probably agree with that, is Californians are not going to file, are not going to, they're going to have to, the taxes won't be due April 15, will be pushed back to October. And then another issue is about the insurance payments. A lot of Californians underinsure because, well, there's all these issues with private insurers leaving the state, and the state having set up a plan called a FAIR plan to provide affordable coverage. Now, the problem is the plan is not funded. So if the plan is not funded, but you promise people something, well, someone's going to have to pay. So I guess my point is that there's going to be a bailout. There's going to be a long-lasting impact on the cost of material, especially at a time when we're putting tariffs on Canada. I mean, we already have a 15% tariff on Canadian lumber, probably going up to 25. We have, I was counting it would take about 10 years, given the pool of labor in California, construction labor, to rebuild the houses.
So you
And
see
we
this
also,
as inflationary.
yes, but I also see the Fed being very happy to blame any bad number on the California fires and
So
telling
like the
us,
new transitory.
yeah, it's going to be, you hear it every time. Oh, it's a one-time adjustment in the price level. And I hate how journalists always let that go. Yeah, well, if you look at a car that's moving, I mean, every minute, oh, it just went from point A to point B. I mean, and it's that's what inflation is. It's a sequence of one-time adjustment in the price level. And if you said that the monetary authority should never respond to one-time adjustment in the price levels, this thing just built on. And that's been the response to, COVID. Oh, we're not going to respond to COVID. It's a one-time shock. Rushing, one-time shock. The North Carolina floods. Every event, there's always a reason not to respond, and I think the Fed will be very happy because it will take away from what increasingly looks like a big mistake, which was cutting rates by 50 basis points in September, and now they have a perfect culprit. And also, Trump will probably be very vocal against Powell. So Powell will need an excuse that not just, oh, I'm cutting rate because Trump is asking me to do so, or I'm ignoring bad inflation data because political pressures. Then it's like, well, obviously, and it wouldn't matter. Like if you look at last month's CPI, for example, that beat was so marginal, it was kind of like a rounding thing, and it really all came down to like a small drop in the price of hotels. Well, all these hundreds of thousands of Californians that have evacuated, they're going to go in hotels somewhere else. So you could see just that just by moving this, you could go from a 2% rally like we had on last month's CPI to the world is ending type of situation.
Yeah, and it is going to be really hard. So where do you see what are you expecting for bond yields? We have MK asking that as well right now. And we always say that this community and chat are very clever because a lot of people are so focused on equities, but you're all zeroing in on bonds, which I think is super interesting and I think right. So what are you expecting for bonds, Vincent?
In general, I would I think you have two aspects of that conversation. You have kind of the fair value conversation and then the liquidity conversation. And on the fair value, yeah, when the 30-year was at 5% and the 10-year was at almost 4.9, yeah, you start to be like, okay, this is interesting. Even if you share my view that growth is higher, inflation is higher, you look at other assets. Yeah, it was a lot of my scenario has been priced in the market. The things that I was slamming on the table with when we were pricing 8 rate cuts, like I mean, in a month the movie is so huge, right? We priced out 7. So what I'm gonna make is not a value comment. I think people could make a reasonable case that bonds are probably fairly valued today, but value doesn't make price. Flows make price. Liquidity makes price, and I think that's something that we'll need to relearn about the bond market, because for 20 years at least, liquidity didn't matter. I mean, it was just there. We're swimming in it, right? First, it was China
And
recycling
this
its
is
surplus
people
from
buying
treasury.
treasuries, right? This is
Yes, yes,
the demand for
yeah,
treasuries.
yes. First, it was uh, the, the, the the currency manipulation in Asia flowing back into the treasury market during the um, uh, Bernanke talked about that. Then that savings glut idea. Then it was the oil producers. Then after that, we asked the banks and the insurers to buy more. So we always had a lot of price insensitive demand for treasuries, and we kind of developed this view that the laws of supply and demand don't apply to treasuries, that we can run as big as deficits that we want, that we have these kind of you will see people even talk about a shortage of safe assets. Um, and now we have a market that is yeah, treasury bonds are becoming an asset like any other, and I think they can overshoot. So my guess is we're about fair value now, but we can and most likely will overshoot. We launched a treasury liquidity market index that looks at all sources of demand and supply for the treasury market, and obviously, I mean, anything that looks at liquidity at a time when you have almost $2 trillion of deficit, and the Fed still shrinking the balance sheet is going to be bearish. So the model has been correct. It's been bearish. Yields have gone up because liquidity is increasingly a force for the
Mm.
treasury market. And if I look forward, I think that the California fires, just by delaying the Californian tax payments, that's going to be a big deal. Remember 2 years ago when we had the big floods in California, and every quarter refunding announcement, refinancing announcement ended up moving the markets like crazy because the Treasury had to issue a lot more debt than people thought because the taxes were not coming in. I mean, eventually they came, but
But they
for
had to
nine
make up the
months,
shortfall.
correct. So there will be that impact. Um, the insurers would have to pay. Insurers are big, obviously they own a lot of bonds, so you're gonna have to sell bonds, and then we'll see what Elon does. But my view is that Doge is not going to cut government spending by $1 trillion. So it will remain in its very high deficit era. And as I mentioned before, I worry that this one thing that's really helped the deficit, especially in the fourth quarter, was how strong tax collections have been. And I doubt that we can keep going at this pace. So liquidity will remain challenging. And I could also see foreigners, not only basically for 10 years, we haven't seen much foreign inflows into the US Treasury market. Uh, I worry that we could actually see outflows.
Outflows,
Um,
yeah.
because that's one tool that foreigners have over Trump. You know, Trump goes around and tells you, "Well, I'm gonna slap tariffs on your economy," um, and foreigners may not want to retaliate with tariffs because this tariffs war ends up badly. And since the U.S. runs a deficit, we kind of win because we buy more from them than they buy from us. So
Mm.
the proper response is not a counter tariff. The proper response could be, yeah, I'm just going to sell some treasuries and try dealing with this, because every time we see the 10-year yield at 4.7%, you see the stock market sell off. So that, and we almost, even after the falling bond yields, we're almost at a pain point. So that's a very easy way for a China, a Japan, or even Europe to get back at Trump. And some of them may be forced to do that, even if they don't want to, for two reasons. One is, well, Trump puts some tariffs, the dollar goes much higher, right? That's the idea that the currencies absorb the movement. If the dollar goes higher, you have to defend your currency. And to defend your currency, you need to sell dollar assets. So a lot of foreign central banks who have, I think of Bank of Japan, for example, who have a lot of dollar reserves, will be forced to sell treasuries to defend their currency. That will mechanically push yields higher. And then the second reason is just the accounting identity of the trades the deficit, the trade deficit of the US mechanically is the capital surplus, right? I mean, this is how balance of payments work. At the end of the day, every asset must be owned. So if you have a deficit somewhere, you have a surplus somewhere. So if we want to shrink the trade deficit, the capital surplus will have to shrink. The capital surplus means that foreigners are pouring more money into the US than US are putting into other economies. Now, these flows take two forms. A lot of it goes into reserves and treasuries. And lately, I think a lot of it has gone into the Max 7.
Yeah.
So if we want to shrink the trade deficit, that capital surplus, mechanically, there will be less dollars to go around for foreigners to invest into the US. So mechanically, that will go down, which I think means that these um, precarious liquidity conditions in the treasury market will be the new normal, and we
I,
will see these kind of brutal sell-offs with increased frequency.
I think this is so important. Brutal sell-offs in treasuries, right? In treasuries, so spikes in yields. I think this is so important, and I think you just kind of summarized the concern that I'm hearing for a lot from a lot of people. So if you haven't had a chance to listen, um, Jem Carson was on with us Monday talking about this. Sorry, last Friday talking about this. Russell Clark, I just did a long interview with him. It's on the on Substack and on YouTube. It's well worth you all listening to that. I mean, he paints a scenario. This is not what he says is going to happen, but the risk that we could see double digits on yields in one of these sort of painful liquidity crisis spikes, 10%, 12%. I mean, a world where the long end of the treasury yield is that high is really, really scary, and things break in that. But someone just asked, and just to sum up again, eccentric asked, why does he think 10-year keeps going higher? And I don't know that you mean higher and stays there, but you mean these swings, these like sort of difficult swings. Is it because of inflation? Others say it's growth, and some say it's a deficit. I think you're saying all three, right? You think
Yeah,
growth could slow down. You're worried about things like tax revenues. You are worried about inflation becoming stubborn, whether it's because of California, it's just sort of getting baked in and running hotter with maybe causes that spike it. And you have less demand globally for treasuries for all the reasons you laid out. So all three of those things come together. That's a problem for the US bond market.
yeah, absolutely, all of the above. And you mentioned higher and more volatile, right? So it may not necessarily look like it. You just see the swings, so it may look at times like it goes down more. But again, as treasuries becoming normal assets, that abnormally low volatility of treasuries is going to be corrected, and we will deviate from what most economists would say is fair value by greater amounts. So the volatility would be greater, and then for all the reasons you explained, yeah, I believe we're in a high yield environment now. I wouldn't go as far as suggesting a double digit yield on the 10-year, but I suspect we'll see weird stuff. I mean,
I think he might have been even talking about 30 years, so I don't want to put words in Russell's mouth, but
yeah,
you still, I mean, the idea is that the bond market has not woken up to the
I
fact
mean, I
that
mean,
it is a
yeah,
riskier asset.
bond markets can be, it's like a volcano that's sleeping for a long time, and then when it wakes up, it shocks everybody by its violence. I mean, I spent quite a bit of time in Brazil, and I mean, what's happening in Brazil is just, it's destroying the bond market is destroying the economy. We saw fragments of that in England with
Someone
these
asked about
collapses.
the UK
Yeah,
market as well.
yeah,
Is
yeah.
that does that remain precarious, or could we see another sort of gilt crisis that forces some policy response?
Well, I think we've kind of seen that, right? I mean, that was the um, that happened in the past month with gilts going to 5%. I mean, the UK has problems that are not dissimilar to that of Brazil or the US, really, with the big caveat that the US issues a world reserve currency. But for the UK, you're a big deficit country. So you depend on the kindness of foreigners, and if foreigners do not like the policies coming out of your government, and you don't have the domestic savings, you can force people to buy your gilts. You can see very big moves that seem to be somewhat disconnected from economic fundamentals.
I think this raises the question, can so there's a lot of confidence when Scott Bessent was, put in
Yeah.
as Treasury Secretary, because he's somebody who understands the mechanisms of global markets, comes from the hedge fund world, and so surely all of the things you're laying out, he is aware of. Is there a scenario where he and or a team within the Trump administration can control this, can control the price of treasuries? Or are we looking at a return for the bond market being a voting machine of its own that that the Trump administration or the UK government, for that matter, has no control of over?
Yeah, I agree with what we said about Scott Bessent in general. I mean, I must say the people that throughout the two administration, Trump had a Treasury were very competent, and I think the first Trump administration would have probably not been remembered so fondly on the economic side had it not been for Steve Mnuchin and basically um, channeling the most disruptive instincts of Trump, and I think yeah, Scott Bessent. I think Steve Mirren is also there, very smart guy. Is big on that kind of FinTweet community, which is kind of cool too. Anyway, so yeah, um,
But
but there's only
no
so
matter how
there's
smart
so
they
much.
are,
You know,
can
you
they?
can have quality people facing bad circumstances, and you know he won't have a magic bullet to fix some of the issues that I if we are if the deficit doesn't shrink, which I don't think it will, and we see more of this pressure from foreign central banks selling, maybe a slowdown in tax revenues because the dollar is too strong. Um, and then again, also think that Scott Bessent doesn't get a blank slate, right? He inherits the Yellen Treasury, and
The
there's this
bills and yeah.
yeah, there's this time bomb there about the distribution of the U.S. debt, right? Where one big reason for the big rally in 2023, 2024, and 2023 was this active treasury issuance, and basically QE, if you will, by switching the funding of the U.S. government from the long end to the short end, which is something that Scott Bessent said that he wants to change, and that's very difficult to do. And again, this is a very EM playbook, right? I mean, people who study EM can tell you that the first thing you do when you have a funding crisis is you shorten the maturity of the debt because you can get more liquidity
Mm,
at the front end, and that's something that's very hard to undo.
yeah. All right, two questions. What about this is from Alan. What about Bitcoin replacing government bonds?
It's not my. I mean, in what way? I guess as a reserve asset, because I mean, government bonds have a role in funding the the expenses of the U.S. government. So, are we suggesting that they?
Yeah.
Well, I don't think the
I
U.S.
think
government
this
can even
idea,
print
that they
Bitcoin. You
floated
know,
that
like,
there'd be a, some kind of like instead of a gold reserve, there'd be a Bitcoin reserve. Yeah, I think there's a lot
but
of
but then even if you already do that, you have to buy the Bitcoins in the first place. I mean, the whole idea of Bitcoin is that they're not controlled by the government. So, I don't really see how that
right
works.
at a time, by the way, when it's rallying, which probably like if you were thinking about it in terms of like a strategic oil reserve, you don't want to fill it up when it's at its record high. Um, and then when we're looking at this, I get this question all the time, and there was the stock market's rallying, people's 401s and their portfolios are going up, and yet we are having these conversations about with really smart people who seem to be extremely concerned about some of the dynamics, sort of, what's under the hood and the risk out there. And then everyone asks, what should I do? Which we can't tell them because we don't know their risk profile and, we're not their financial advisor. So I've been trying to think about a way to ask this question that can help give them some guidance. Do you think we are entering a period that is just generally more risky, Vincent? Like if you have to look down, we look at when we make a decision about that, we look at our own risk appetite, right? How old am I? When do I need my money? All of those kind of good things. And then you look at the environment. Are we in a peace dividend environment where global growth looks strong and things look pretty calm, and so you're going to focus on valuations? Or are we in a macro environment that is full of risk, geopolitical risk, and other risks that should and make people have conversations that really ask, like, in a risky environment, I am this kind of risk profile, and in a risky environment, what looks good to me? Like, how would you categorize the macro environment that we're looking at?
Yeah, if we try to take it like you are doing, okay, is it is it risky out there? I would agree with your assessment. I think that I see the macro risk building up, and I see the the amount of compensation that you're getting for that risk falling. Again, I'll go back to this stat. Household net worth has increased by 50 trillion since COVID. And that's across all assets, right? Houses, crypto. But I'm not even sure crypto fits into that because people don't report. But so assets are a lot pricier relative to um, actual cash flows. You're getting less for your money. And yes, I would agree that generally the balance of risks is tilting towards greater risk, in large part um, because assets are overvalued, and because the risk of a pullback is much higher. And I don't want this to be construed as a anti-Trump point. I don't.
Mm.
I think there are great things about Trump. There were great policies. In 2016, for example, I thought Trump was the right man at the time, because that buffer was here. I mean, stocks were trading for what, about probably 16, 14, 15, 16 times earnings. I remember X Cash Apple was like probably around 10.
Crazy, right? To think how much
Yeah,
has changed.
yeah. 10-year yield was 1.5. Inflation was 1%. Government deficit was less than 2.2% of GDP. The unemployment rate was pretty high. So what Trump did, which is, unleash animal spirits, strengthen the dollar through tariffs, um, do big tax cuts, all that, there was a big margin, right? So a lot of it was growth accretive. Now we're working from the exact opposite situation. 10-year yield is almost at the pain point, right? I mean, we are almost, that pain point is around 4.78%. We're at 4.6 today. The deficit is huge. Inflation is, still around 3.5%. The dollar is massively overvalued. So we no longer have the buffer, if you will. Valuations are obviously twice as high as they were back then. So that's why the same actions in a different context can lead to a different outcome.
Yeah, that's the thing. Focus on the policy, right, everybody? This is a really interesting, and we're going to start to wrap it up. This is a really interesting because to this point, I know, Vincent, in one of your notes, which I loved, you were like, okay, what if everything turns out great? Like, what are the opportunities here if you're going to lean in and they're able to move policy and they're able to make big changes and we don't have some of the blowups? Because Ched was just saying, bullish to hear this consistent skepticism across so many interviews about the capability of tech bros and Doge to, impact at think folks will be pleasantly surprised at the end of 2025. So like, what if things go right? There are some areas where you see some opportunity, correct?
Yeah. So I had, and I understand the, the feedback here. I mean, I think it's well put. When we talk about being prudent and hedging, I think it goes both ways. It's not just about being a constant pessimist and, the chicken little, well, the sky's going to fall. We also have to think of the risk that thing goes right and that we're not positioned accordingly. So I think that's a very good point. And that's something that I consider. So I had a report that you mentioned. It's called Four Trades in the case MAGA succeeds. One of these trades is banks, and then especially capital markets. So if MAGA succeeds, the economy doesn't slow, the yield curve keeps steepening, the bank credit expands. Default rates are going to be much lower than people think, and banks still they have rallied quite a bit. I mean, this is my favorite sector last year, and it was either the best or the second best, almost as good as tech. So they've rallied quite a bit, but we still have some of the scars from that regional banking crisis, fake recession last summer. So they're not a very expensive sector, even after the big rally. And then I think the trade moves more away from the lenders, which will still do well, but really it will be the capital markets player, because we would see, I think, an explosion in deal making, in IPOs, private equity, a lot of cash. Basically, been funnel outside of public markets. If you look at the VC world, you used to IPO Series A, maybe a B, and then you go to the market. I mean, now people do Series F, right? So and people have tapped all these pools of liquidity outside of capital. But again, the pipeline is longer, but it still leads to the same exit, which is the stock market. And for 3 years since the SPAC boom, basically IPOs have fallen. But I'm talking by 90%, right?
Mm.
Same thing with M&A. We had this kind of very uh, aggressive FTC DOJ with Andalina Khan. So the willingness to do deals has been very limited. So yeah, if we get things right, I mean, watch out. Like these revenues could explode higher, and it doesn't matter. The PE on some of these large investment banks probably got from 8 to 15, right? I mean, but the E could triple. So that would be one spot. The other area that I'd be looking at would be anything that benefits from lower oil prices. I think one key area where Trump can succeed, whether Trump succeeds or not, ultimately depends on oil prices. So if I'm right about inflation, well, my view of inflation, and I've been here many times, so people know core services is stuck at 4%. It's a haircut indicator, right? We're at 4% core
Mm.
services. Shelter is not coming down. I mean, maybe artificially, optically, but realistically, like home prices are not going to rents are not going down to 2%. And then core goods, because of tariffs, because of reinventory, are no longer going to be. So there's only one part of the CPI that I never talk about because it's so volatile, it's the energy component. And maybe we can have everything go wrong, but if we see oil go down to $40, then yeah, we hit the 2% target. The Fed can cut, and in this case, you want airlines, airlines and refiners. So, and I would also add gold miners to that list. Yeah, we'd have this consumer boom. The revenge travel would just be the new normal. Airlines actually have some pricing power because of all the issues we had at Boeing. We don't have the overcapacity issues that usually plague
Mhm.
the industry every time. Airlines are usually big destroyers of capital, but this might be the exception. Refiners, it's obvious, right? As oil for them is an input. Typically, when oil prices fall faster than gasoline, so their margins expand. And then the last one would be gold miners. When I look at what would make America great again, what does Trump need? Well, he needs a weak dollar. I think that the strength of the dollar is a problem if we want to rebuild industries in Ohio and the Rust Belt. We're not going to do it with the dollar at 1 against the euro and 150 against the yen. So you need a weak dollar. We probably need negative real rates because, as I was mentioning, these higher rates are slowing down the economy. So imagine more bullying of power, we need more rate cuts, blah, 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 and we need cheaper oil. What is that good for? Weak dollar, negative real rate, cheap oil. I mean, this is kryptonite for gold miners. And I mean, look at a chart. These guys are starting to rally quite hard, but they're lagged. Like since COVID,
Mhm.
basically stocks and gold have more or less doubled. Gold miners have gone nowhere. So and gold
Yeah.
at the end of the gold miners are in the business of transforming energy into gold. So if I'm saying that gold prices are going to go up and energy prices are going to go down, that means your margins for gold miners are going to explode. So this would be my Trump bet in case things go right. And I absolutely agree. The spirit of the question, you need to have a plan, not just for things to go wrong, but also for things to go right.
Right. But you have to have a plan for both, which is why this keeps coming up, because sometimes it feels like people just have a plan for
Yes,
one
I
side of
think
it.
that's why our conversation kind of had this bearish tilt because we were talking at a day. I think the stock market made a new all-time high today, right?
Right.
And you
Right.
see all this, after the inauguration, right? There's all this bullishness. There was a little bit of fear when Trump was elected, and I think it's been kind of resolved just because we've seen Zuckerberg and Bezos at the inauguration, which to me is entirely
Yeah, you
meaningless.
always wanna temper it, right? When you see everything going well, you wanna say, "What could go wrong?" When everything's going wrong, you wanna say, "Where's the opportunity? Where can things go right? Where is it mispriced?" I mean, that's just the smart way to do it. I will also mention that who's the other person that's talking a lot about gold miners right now from a technical point of view? Dow. Dale Pinker. Go back and watch the conversation I had with him. I think it was on January 6th, and get a sense of his levels. And he's been tweeting about it because he just emailed me that it's hitting some of his levels. So keep an eye on that, and you can go check him out on Twitter. Vincent, this was so fun and so chock full of really, really good advice to make sure everyone's considering all the possibilities. We were going to have some fun at the end, but we don't even have time. I'll get them for you next time because we've gone a little bit over. But I really, really appreciate you taking the time to sort of see both sides of the scenario with us. We love catching up with you.
Always a pleasure. We'll talk soon.
Thanks so much. Thanks, everybody. Great chat. You're also smart for watching both sides of the equation as well, especially staying keyed in on those bonds. And we'll continue to do the same. We're going to talk about that IPO market and some of the possibilities, dig a little deeper on that on Friday. So stay tuned for that. I'll talk to you all later. Thanks so much. Take care and good luck out there.